Okay, welcome back. We did discuss about cost model, how to calculate depreciation. I give you two examples. That is number one, using the straight line method, and the second one is using reducing balance or diminishing balance methods. And the second technique is to deal with the subsequent measurement of PPE is by using revaluation method. I did explain, okay, at the beginning that you cannot selectively choose which PPE using cost method and another type of PPE go to the valuation method. You cannot do that. You have to, if you use cost method, you have to apply that method for all kind of assets. If you use a revaluation model, then you have to apply for all types of all classes of PPE. So the alternative measurement for the cost model is revaluation model, whereby under revaluation model we allow the assets to be revalued and recorded based on the fair value. So this is another way of doing the recognitions, the measurements. So the principle for revaluation of this asset is that revaluation must be made with sufficient regulatory ability. It limits the managements to cherry pick or selectively choose which assets to revalue. So you have to do revaluation for all classes of PPE. AASB 116 or IAS number 16 para 39 did clearly say that revaluation have to be done on asset by asset basis, one by one basis. The increase is not recognized in profit and loss. It will not increase your net profit. It will not go to your net profit, but it go to your the second part, that is other comprehensive income. Let me explain about this. When we study accounting at lower level, we have revenue, then minus expenses, then we have net profit here. Net profit. So it will not go under this part, but from this profit, we're going to add another component here. We call it as OCI, other comprehensive income. So the net profit plus other comprehensive income will be your total comprehensive income. So this is the new part for the revaluations, for the revaluation gain or losses. And we're going to report the net figure here, loss or gain on disposal of assets. So it will not go to the profit and loss. This is the profit and loss, P&L. This is the OCI part, other comprehensive income. Let us look at this example. On 1st January, an entity carries an item of land at cost of 100,000. So this is land, non-depreciable assets. So the land is revalued to 120,000. So mean plus another 20,000. Okay, you found that the value of land increased by 20,000 to 120,000. So the new carrying amount of this land is 120,000. It gives an increase in the value of asset. When increase in value of asset, that is gain. Okay. What happened? What are the appropriate accounting entries on revaluation of assets? So I'm going to debit my land. This is increase in land value. So I'm going to debit here. Debit 20,000. And this gain, I'm going to record gain on revaluation of land, OCI, credit, meaning increase your total comprehensive income by 20,000. So debit land, credit, gain on revaluation. Debit land, credit, gain on revaluations. Okay, is it okay? So the gain on revaluation of asset previously recognized in other comprehensive income is accumulated okay, or transferred to equity similar to the closing entry to transfer revenue and expense amount to the profit and loss, and the specific equity account being asset revaluation surplus. So this gain and losses, gain on revaluation will not go to your retained earning account, it will not go to your profit account. We have your capital, this is your capital, then you have accumulated profit or retained earning, retained profit. But this profit 20,000, gain 20,000 will not go to your retained earning account. No. We're going to create another account. We call it as asset revaluation surplus, ARS. ARS. Mean from this gain 20,000, I'm going to close the gain account. So I'm going to debit 20,000. I'm going to close this account, and I'm going to transfer to the reserve account known as asset revaluation surplus. So this is a reserve account. This is your reserve account. What you learned in chapter 15, if I'm not mistaken, reserve account. So this is the first part. Recognize increase in value and gain. Put it in your other comprehensive income. From your other comprehensive income, transfer to asset revaluation surplus. Okay. Can you transfer it straight away? No. Yes, you can do it. Debit land credit asset evaluation surplus, but we're not able to see the amount in the statement of profit and loss and other comprehensive income. We want to see, to examine what is the increase in value of that asset for that particular year. So that's why we put it as OCI first, and then later on we're going to close the OCI account, transfer to asset revaluation surplus. Okay. Another example here, but this is for the first one, this is for non-depreciable asset. We don't have depreciation for this. Okay, we don't have depreciation for land. In this example, it's a bit complicated. Why? Because we have depreciation. So we need to adjust the depreciation amount as well. So an item of plant has a carrying amount of 50,000, being original cost 60,000 less accumulated depreciation 10,000. Now we need to revalue this asset downward to 24,000. What does it mean? This is the cost of this plant, 60,000. The accumulated depreciation is 10,000. So the carrying amount is 50,000. This is based on our record. This is our CA, carrying amount 20,000. However, when you do revaluation, when you perform revaluation, you found that the value of this asset is only 24,000. The value of this asset is only 24,000. So how are you going to do this? Okay, there are several steps. Step number one, I want you to close this account first. This is step number one. First step, we're going to close our accumulated depreciation account. I'm going to offset with these cost accounts. So I want to have asset that cost me with a cost of 50,000. So I'm going to credit this cost account and credit accumulated depreciation. Let me close the accumulated. This is credit, this is debit, am I right? So to close this account, I'm going to debit the account and I'm going to offset in the cost account. So I'm going to credit. So that is the first step. The first step is to write off accumulated depreciation of plant. That is, we're going to reduce the recorded amount of assets to 50,000. So I'm going to debit accumulated depreciation 10,000. So now it becomes zero. Accumulated depreciation is credit. When I debited this account by 10,000, the amount would be 50,000. For plant, okay, when we credit 10,000, so the balance of the plant now is 50,000. So this is the first step. Okay. So from 50,000, Now we need to compare with 24,000. How much? What is the difference here? The difference is 26,000. So the value reduced by 26,000. Okay. The value of these assets, if I draw the account for plant here, you have 60,000, then you debit 10,000. Now I'm going to reduce another 26,000. So I'm reduce another 26,000. So the new value will be 24,000. So this is the new value of assets. So you need to credit the plant account by 26,000. So I'm crediting my plant account, credit here, by 26,000. Reduce in value is known as loss. Loss in revaluation. Loss in revaluations. Yeah. Loss in revaluation. So this is loss in revaluation. Previously is gain on revaluation, not disposal. Gain on revaluation. Maybe I did pronounce it correctly. Gain on revaluation. This one is loss in revaluations. That is 26,000. 26,000. Oh, okay. The revaluation increase and decreases involve reversal. Sometime this year increase, next year, maybe after a few years, we have revaluation reversals. Yeah. There is a revaluation decrease due to change in the fair value of asset, and there has been previously revaluation increase to the same asset. So in this case, we have reversal. Yeah, there is a revaluation increase to asset that have been previously recorded a revaluation decrease in the profit or loss. So this is more on revaluations model. Yeah. For example, in this example, for these assets, if you look at this example, this graph, the value of this asset originally is 10,000. Okay. Now it increased to 200,000. Okay, this is the year 2. Increased to 200,000. And later on, the value of this asset, when you make the valuation, it go below the original cost. This is the original cost. Okay. So in that case, for example, the loss in this value, this part, we must adjust to our other comprehensive income, or any additional loss below the original cost must be recognized in the profit and loss. This is the difference. Let me explain again. Okay. First, you bought this land for 100,000, and then the value of land increased to 200,000. So in this in this part, you have a gain on revaluation. Remember, right? It go under OCI. That is to 100,000. Okay. Later on, the value fall to 80,000. This is 80,000. Okay. So the amount that you can reverse, or you're going to record as your loss on reversal, on revaluation, is only 100,000. This will be your OCI, loss on revaluation. OCI, other comprehensive losses. Yeah. Comprehensive income, loss on revaluations. And the 20,000 will go to your profit and loss. So this is the treatment for revaluations. Okay. Example. Okay. An entity has a block of land with a carrying amount of 200,000, previously revalued outward from 100,000. The following entry were recorded when the asset was revalued outwards. So debit land, credit gain on revaluation of land. So this is the gain. And then the second part, we're going to close the revaluation, the gain on asset, the gain on revaluation, and we transfer to asset revaluation surplus. This is our reserve, ARS, asset revaluation surplus, under reserve. This is our reserve account. Okay. So in this case, what are the appropriate entry if the asset subsequently revalued downward to 160,000. So from 200, it go to 160. That's situation number one. Situation number two, what if from 200 revalued downward to 80, mean fall below the original cost? So let us look at the example. For the first one, it's very easy. We're going to recognize this loss as loss on revaluation. It go to under OCI, other comprehensive income. Yeah, put it OCI there. And going to credit the land. Credit the land means reduce the land value. Reduce the land value by 40,000. 40,000. Okay? By 40,000. Then I'm going to close this loss on revaluation accounts. This is debit. So to close this, I'm going to debit credit. And I'm going to offset my reserve. This is reserve. Your reserve, asset revaluation surplus. Previously, you have 100,000. To reduce this, I'm going to debit this reserve. So your reserve now becomes 60,000. So this is why we debit 40,000. Okay, debit. That's very straightforward, very easy. However, in the case of the 80,000, devaluation to 80,000, it has two parts. The first 100,000 is fall under OCI. That is because you're going to offset that to your asset revaluation surplus. You already have your asset revaluation surplus 100,000. So you're going to offset this account first. So land, I'm going to credit by 120. This is the loss in value of land. And the first component I'm going to first do is offset to my OCI first. Maximum is 100,000. And the balance will go loss on revaluation, straightway go to your profit and loss. This is 20,000. As I mentioned before, under your income statement, we have a revenue, then we minus expenses, you get our profit, then we minus all the taxes, and later on you are going to add your other comprehensive income to get total comprehensive income. So the 20,000 will go here, and then 100,000 will go here. Yeah, under other comprehensive income. And then you're going to reverse back your loss. You're going to offset with your ARS here. I'm going to offset here 100,000. So I'm going to debit my ARS account 100,000. So my balance of asset devaluation reserve now, surplus now is 0. So loss on revaluation of land is going to be 100,000. Loss on revaluation 100,000. So this is the process when we deal with revaluation and also reversal. Okay, so depreciation of revalued asset also apply for both cost and revaluation model. If you choose the cost model, you need to provide depreciation. If you choose revaluation model, we still need to provide depreciation annually. So depreciation is not determined simply as the change in fair value of the asset over time. It's calculated as the pattern of economic benefit relating the assets and residual value of that asset. So when we discuss about depreciation of revalued assets, when the value of the asset increase, so what will happen to the depreciation for that year? Certainly, the depreciation will also increase. Okay, in this example, an entity has an item of plant that was revalued to 1,000. The asset is expected to have a remaining useful life of 5 years, with benefit being received evenly over that period. So the residual value is 100. So what is your depreciable amount? 1,000 minus 100. So this is depreciable amount, 900. Okay. What are the appropriate journal entry for year 2021-2022 for each of the following situation? Situation number 1, at 30th June 2022, no formal revaluation occurs and the management of the entity assess that the carrying amount of the plant is not materially different from the fair value. So the value is still 900. So what happened to the journal entry depreciations? Second is we perform a formal revaluation and we found that the excess value the value of this plan now is 890. The value of this plan now is 890. So how we're going to record that? If this asset can be used for 5 years here, 5 years, for situation 1, this 900 will be divided by 5 years. So every year, your depreciation will be 180. 180. Yeah, 180. So I'm going to debit depreciation expense 180, credit accumulated depreciation, by 180. Debit depreciation expense, credit accumulated depreciation expense. So what is the value of this asset later on? The carrying amount, the cost will be 900. The accumulated depreciation, the cost will be 1,000. 1,000. The accumulated depreciation before this we have 100. So 100 plus 180. So it becomes 280. So the carrying amount is 720. So this is under cost model. Okay. Under situation B, a formal revaluation occur, and then we found that the value of this asset is 890. 890. Okay. So when this happen is on the following year, 30th June 2022. So in the first year, we're going to debit depreciation expense, 180, credit accumulated depreciation 180. So this is what we did. First one, depreciation, that is 1,000 minus 100 divided by 1/5. So this is the normal one. Debit depreciation 180, credit accumulated depreciation 180. Okay. And then the second step is to offset the normal depreciation with the plant account. So I'm going to offset this 180, going to debit accumulated depreciation, okay, and credit plan. Okay, are you okay with this? So the asset now write down to 820. Okay. And then we need to revalue these assets. When we revalue this asset, we found that the value is 890. So from 820, this is 820, carrying amount is 820. So when we revalue the asset to 890, we are making gain. So I'm going to debit here the plant by 70, increase the value of that asset by 70, and then I'm going to credit the gain on this, not disposal, gain on revaluation by 70. So this is gain from revaluations. Okay, and then finally I'm going to close the gain on revaluation and transfer that gain to our asset evaluation surplus. So this is a two process as explained down here. Depreciation is allocated in accordance with normal depreciation principle. Therefore, a formal revaluation occurs. The accumulated depreciation is write-off and asset revalue. The statement of depreciable the statement of financial position at fair value is 890. No associated accumulated depreciation. Subsequent depreciation calculation are based on the fair value of this asset. So this is the value. Our depreciable asset is 1,000 minus 100. So your depreciable amount is 900 divided by 5. Maybe I did explain this wrongly. This should not be accumulated depreciation. Sorry, I'm sorry about this. I got confused with this. Your accumulated depreciation is still 180. The 100 is residual value, not accumulated depreciation. So this should be 820. Yeah. For the first example, accumulated depreciation is 180. Yeah. I did. Yeah, this is the residual value. Sorry about it. This is the residual value. So under normal circumstances, the carrying amount is 820, 820, and then we solve that part first, and then we do our revaluations here. Revaluation, increase in value of 70. So now the value of this asset is 890. Any questions so far? So that is